Hi and welcome to today's webinar. I really hope you're well. My name's Aran Curry and really looking forward to spending the next hour with you looking at how do professionals successfully take their property profits and how you can do exactly the same, and also looking at all those recent tax changes and help you understand whether they impact you or not, and if they do impact you, what you can do to mitigate that impact. We've got a few hundred of you registered for the webinar today, so while I'm just waiting for those people to climb on the webinar, I can see people registering right now. Just a couple of quick domestic things. The first thing is, as we're going through, I will be launching up a couple of polls. A poll is where I just ask you to give me some general feedback. In fact, I'll launch one up now, and you can see the first example. When I launch these up, if you can click on them as quickly as possible, it just gives me a great feel of where you are, who's in the audience, so I can make sure I tailor the webinar to fit you best. So the first one here is just asking, have you heard me speak before? Have you been on a webinar and heard me speak before? So that's quite an easy one. It's either a yes or a no or a not sure. Now, by the way, when I push these polls up, sometimes depending on your technology and your software, you're not able to click, which can be very frustrating. What I'd ask you to do then, if that's the case, is use the chat box down at the bottom right of your screen. There's a chat section. It's private. No one else can see when you type in the chat box, by the way. So just use the chat box and answer the question. Ideally, click the poll, but if you can't, use the chat box. I can see there's about 60% of you have heard me speak before, which is quite normal for a webinar like this, and there's about 40% of you that haven't. So welcome back to those that have, and those of you that haven't, then welcome. You know, I'm not going to cover me in detail. I'll do a quick slide on me, give you a bit of my background, but if you want to check me out more, you can always go to www.arancurry.co.uk, and the way you spell my name will come up on the screen shortly. So, okay, so thank you for clicking on there so quickly. The other couple of domestics, I've talked about using the chat box if you can't enter the polls. If you've got questions as we're going through today, which I'm sure you will have, or some of you will have, you know, what I'd encourage you to do is type in your questions at the bottom right. Again, use the chat box, type in your questions, and then what I guarantee to do in the next 48 hours, I will get every single question answered, okay? I can't guarantee to get it answered on the webinar today. We may or may not have time, but what I can promise is if you've typed a question in, either me or my team will come back to you and make sure that question actually gets answered. So you know, type those in, and then we can help you with those questions, okay? Okay, so I'll just put up the second poll, which was just to ask how many buy-to-let properties you currently own, because you know we have some people, I'm sure, that don't have any at all. We've got some in that 1 to 3 bracket, etc., and some right up 11 plus. You know, like myself, got a lot more properties. So if you want to click on that as quickly as possible for me as well, just so I've got a feel of the audience's experience of buy-to-let, that would be absolutely great. The final thing I'd say before we get started, I can see quite a lot of people on the call now. So as I said, we've got hundreds of you registered. So my recommendation, people always say, well, Aran, you know, when we join a webinar, what would you, is there any tips you've got for our learning? So we're going to be together for the next hour or so, maybe a little bit longer. What I always say is, first of all, get somewhere comfortable. Secondly, if your spouse is watching TV and you're sat on an iPad or your laptop or something like that, my suggestion is just move somewhere else. They won't distract you, and you won't distract them. Okay, they don't want to hear my voice for the next hour. So that might be a tip for you. Grab a drink so that you're comfy, and grab a pen and paper. You know, if you're going to spend the next hour with me, I better deliver some value to you, and I will do. So therefore, my recommendation is grab a pen and paper, because you'll want to make some notes. You're going to learn some stuff that is worth note-taking about. Okay, so yeah, we've got about 30% of you have clicked to say you don't have any investment properties at the moment. We've got about 30% in that 1 to 3 bracket, which is quite normal. About 28, 27% in the 4 to 10, and then the rest of you in that 11 plus. So we've got a good range, which is normal for a tax webinar. Wherever you are, by the way, on that range, you're going to find today's webinar really, really valuable. So, okay, so let's get that closed down. Let's make sure everybody's gathered in, which you are, and yeah, let's get started. So, okay, so today we're going to be looking at what I call the time-tested tax toolkit, the time-tested tax toolkit. I'll explain more what that is, but we want to make sure that the information we're going to cover today, let's just get clear on what that information is. So first of all, I'll explain what the time-tested tax toolkit is, so you know it's all about being tax efficient with our investing. We'll cover the recent tax changes, so we'll talk about the recent tax changes, what they are. I'll help you identify whether they impact you or not, because there's a lot of misunderstanding about them. There's a lot of people unclear. We'll talk about stamp duty and interest rate relief. So, you know, because they're the two main changes, sometimes called Clause 24 or mortgage interest rate relief. So we'll talk about both of those, get you really clear on those. I'll show you if you are going to be a 40% taxpayer, you may be already, or if the changes tip you over, I'll show you 10 mitigation strategies to mitigate the impact of that. And then most importantly, I'm going to show you two foundational principles, two really simple principles you'll understand when we finish the next hour. You'll fully understand them, and you'll see how they make you income tax efficient, capital gains tax efficient, inheritance tax efficient. I'm going to teach you how to run your portfolio, whether you've got one property, 2, 5, or 50, as tax efficiently as someone would have 100 or 200. The beauty of property tax is that you can, you know, if someone's got 200 properties, it's not one rich for the wealthy and a different, one rule for the wealthy and a different rule for everybody else. You can use the exact same strategies the wealthy use, even if you've just got 1 or 2 properties. So that's what's on the agenda for us on this webinar. As I said, there's probably going to be about an hour of education. Okay, I reserve the right to go 5 minutes over or 5 minutes under, but about an hour of education. At the end of the webinar, you know, if you've got great value from it and you've enjoyed it, you may say, well, what else do you do as a company? So at the end of the webinar, once we've done all the education, if you are interested, I'll show you, my company have a done-for-you service where we build people in a hands-free manner. We source amazing properties, we negotiate on them for you, we sort the solicitor, we sort the mortgage, we get it bought, we refurbish it for you, we tenant it, we manage it. We provide a fully fledged done-for-you service. We've helped over 1,000 clients to buy property in the last decade, and we do it all for you. So if that's potentially of interest, you may want to plan to stay on for another 20 minutes at the end of the educational piece, and I'll talk you through that as well. If you just want the education, that's totally cool. You'll get the education first, and then you can stay on if you want after that. Okay, so that's the plan for the webinar. So let's get stuck in. Now, when I'm teaching property investing as a whole, you know, people come to my one-day events, my 3-day events, right up to my one-to-one coaching clients who pay me £25,000 to coach them for a year. You know, just for an hour a week I coach them over that year period, but it just explodes their property investing. By the end of the year they're financially free through property, or nearly financially free. And whenever I'm teaching or coaching, there are what's been really interesting is when I decided to start teaching about 4 years ago. Before that I did lots of building my own portfolio and lots of helping other people. But when I decided to start teaching, I went and interviewed literally, you know, hundreds and hundreds of people who'd got to financial freedom through property. And I looked at what their core skills were. What were the skills and abilities that they had to bring to the table? And then what I did was I went and interviewed and looked at, you know, a couple of hundred people who were intelligent, articulate people who'd set off on their property investing journey, but somehow had fallen over on the way. They'd got no properties, or they'd ended up with 1 or 2 or 3, but then they'd stopped. And you need to get to 8 to 10 properties probably to get financial freedom, where it covers all your bills and everything you currently spend. So I studied why those people were falling over. What was really interesting, when I studied both groups in detail, I was able to identify 10 core skills. 10 core skills that if you have those skills at an 8, 9, or 10 out of 10 in your locker, and you take action, because you have to take the action as well, I can almost guarantee you'll get to that point of financial freedom. But the frightening thing was, with just 1 or 2 of those skills missing, just 1 or 2, you know, everything else can be 8, 9, 10, but 1 or 2 are at a 4 or a 5, you'll fall over along the way. You're not going to get to the end goal and where you want to get to. So for me, when I'm teaching it, I want to teach people the 10 core skills, because if they can get all 10, either themselves to an 8, 9, or 10, or they say, do you know what, these 3 or 4, I'm going to personally get to an 8, 9, or 10. The others I need to outsource because I have no interest in them, or I don't want to do them, or I need help with them, someone else with more experience. But you then know what you need to master. Now, today's webinar is not about that. So today's webinar is not about teaching these. I run another webinar for that. If you reach out to my team, info@propertyinsight.info, they can invite you along to a webinar where I cover those 10 core skills in detail. But what we're going to do today, one of the 10 core skills, which comes under the profit on this left-hand side, the profit segment. There's 5 segments here: purpose, plan, payment, purchase, profit. But under the profit segment, there's the time-tested tax toolkit. Now, when I teach tax, there's about a day's worth of teaching. So we've got an hour together, or 50 minutes left now, and there's about a day's worth of teaching. So I cannot possibly cover it in detail with you today. But what I can do is give you the core elements. I can help you to understand what the changes have been. I can help you to understand what you need to do about it, and I can definitely help you understand how the professionals take their profit. So let's go ahead and do that. So, okay. Now, just before I dive in, for those of you that have seen me before, forgive me for this, but for those that haven't, it's useful just to have a very brief bit of my background. So, my name's Aran Curry. I know you can't see me, but you can see me there on that slide. I'm the founder of the Insight Group, which is a group of 5 companies, over 40 members of team now that work with me, and we build, as I said, really successful property portfolios. Those 5 companies all come together, world-class delivery. We're the largest portfolio building company in the UK, both in terms of size of team, in terms of number of properties that we buy for our clients, in terms of number of clients, etc. So that's the Insight Group. And as I said earlier, I've got over 200 properties in my portfolio now, and we've helped our clients over the last decade to buy over 1,000 properties, and now looking to buy kind of 30 or 40 properties a month for our clients. Okay, and then we have the education arm. I'm lucky, I'm blessed that my businesses have management teams in place that do an awesome job. I definitely add value, but they do an awesome job. So I get my passion from doing webinars like this, my one-day events with over 100 people at them, where I'm helping many people at once. So my education business, which is about 3 years old now, Property Investing Made Easy Education, we've helped to educate over 20,000 people in the last 3 years alone in property. So I don't share these figures with you to brag. I share these figures so you get a sense that I've been here, seen this, and I understand it. One of the key things for me is committing to mastery. It's the understanding that people that have more experience than you, that have been doing this for longer than you, in the right way, there's no point doing the same year for 40 years, then you've only actually got 1 year experience, just done it 40 times. But people that have done this for a long time and have got real loads of experience at it can bring a lot to the table. They can save, my first 10 properties, when I wasn't getting help from anybody, I was losing money out. It's costing me hundreds of pounds or thousands of pounds or tens of thousands of pounds. So my goal in the next 50 minutes is to give you real great content, real great value. I believe in mastery. I believe in going to someone with experience, so I teach people to do that, but therefore I did the same with the property stuff and the tax stuff especially. So what do I mean by that? Well, basically we're going to dive in to what I call the time-tested tax toolkit, okay, which is all part of this safe, secure portfolio plan. You can build really successful portfolios safely and securely, but I'm not an accountant. I want to put that warning up right now. I'm not a trained accountant. My expertise lies in property. However, I commit to mastery. So when all the new changes came in about 18 months ago, I went and interviewed 5 of the leading property tax accountants in the UK, and I said, hey, I want to teach my clients this. I want to make sure we're doing the right things. I want them to know if it's going to impact them or not, and if it is going to impact them, how to mitigate it. And they gave me some awesome training. They're the distinctions you get when you go to the best in the country. So they're the things that I'm going to share on with you now. Now, on the webinar, with a couple of hundreds of you on, I can't possibly make sure that I understand each and every single one of your personal scenarios. So the challenge I've got today is I'm talking generically. I'm talking to you generically. So what I would encourage you to do, I'm going to talk to you generically. I'll give you some key distinctions, some great learnings. If you go to your accountant and talk about those great learnings and they look blank, or they're not, which is another phrase for they're not an expert in property tax, because I used to have a great business tax accountant, but he wasn't good at property tax because he wasn't involved with property. great business tax accountant, but not a great property tax accountant. So if you go to your accountant and they look blank, or they're not a great property tax accountant, maybe you need to change that. Maybe you need to use a different accountant, and we can recommend someone to you. Okay, there's nothing in it for us to do that, but we can recommend and help you. However, if you go to them, my goal is that I give you enough distinctions that you can go and have an educated conversation where you're in power, you know what's going on, and you can then work with them to decide your best plan for your for your structure. Okay. Now, the other message I'd give you is this stuff isn't rocket science. So many people I meet are frozen with their investing because they're worried about the tax changes, or they're worried about how to set things up. I'd rather you bought 10 houses all set up wrongly, but at least you've bought 10 houses and you're making some money and you're paying more tax than you should, versus you don't buy any houses because you're not sure how to set them up. You make more money buying some and paying more tax than you should than you make not buying any. So whatever you do, go do it. I'm going to give you enough in this session that you know exactly what you need to do. Okay, so let's look at what are some of the recent changes that have come in with regards to tax and with regards to kind of budget announcements and things like that. So what are some of the recent changes? Well, first of all, back in 2016, there was an increase in rent-a-room allowance. If you rent a room out in your house to somebody else for about 20 years, they'd never changed the allowance. You could earn a certain amount before you paid tax, but it was, you know, it was around, I think, £400 a month, just over. So they increased that now to £625 a month. So you can rent a room out in your house, earn up to £625 a month. There is no tax to pay. Okay, it kicks in after that point. Okay. The second thing in 2016 as well, there was the removal of what's called the wear and tear allowance. Now, this mainly impacted people who had maybe a house of multiple occupation, renting out to students or young professionals, etc. You used to be able to say, here's the rent that I've taken this year. Let's say it was £20,000, and you used to be able to say, well, 10% of that, so that's £2,000, I can put offset against my income as wear and tear allowance. You know, there would have been some damage to the beds, to the sofas, to other things like that. So, and regardless of whether you did do anything with beds and sofas, you could still offset it. Well, the government understandably came along and said, you know what? People can add up what they've actually spent. If they've changed beds and sofas, they can claim for them. If they haven't, they can. So that changed in 2016. You can't just claim 10% automatically. You can only claim for what you've actually spent and have receipts for. Okay. Back in 2016 as well, there was a freeze of LHA rents. Now, if you're not sure what that is, LHA is Local Housing Authority. So if you've got a tenant in your property who is old DSS, now Local Housing Authority, soon to be Universal Credit, but if you've got a tenant in your property who is on benefits, then, you know, in your area, there will be a certain benefit allowance for a 3-bed property. There'll be a lower allowance for 2-bed. There'll be a lower one for 1-bed. But it's a set allowance, and as long as they qualify for it, that's what they get paid. And generally, they went up with inflation. But what the government have done is they've said, you know what? We're going to freeze that for 4 years. We're not going to put it up. Okay. The challenge for you as a landlord is if you rent to an LHA tenant, you need to be putting your rents up every year, 3 to 5% a year. Always. I've done it for the last 20 years. And I've been a big supporter of LHA tenants. You know, people knock them. They say, oh, you're going to get a bad tenant. With all tenant types, there are great tenants, there are bad tenants. Whether it's a young professional, whether it's an older professional, whether it's a family, whether it's a benefits tenant or a student, there are great tenants and bad tenants. So you need to make sure you're getting great tenants, whatever you do. But you want to be pushing those rents up 3 to 5%. So it's moved us a bit further away from benefit tenants, because if the rent's staying still for 4 years, we need to keep pushing the rents up, and you'll see why later on. That's not to say we don't use them. You know, they're great if they're on other benefits as well. So if they've got disability benefits in the background, they can be great long-term tenants. You know, a 50-year-old who very sadly, you know, owned their house for 25 years, got in an accident, they've become disabled, they got their house repossessed, now they need to rent somewhere. You know, they'll rent your house, they'll rent it for the next 20, 25 years, they'll really look after it, and they've got other benefits as well as their housing benefit that help them to pay any rent increases, so that they can be a great tenant. So don't rule out LHA, but just be careful with it. Be careful to choose the right ones, okay, and understand that this freeze is in place. The scary thing for me, actually, as a human being, by the way, is, you know, as a landlord, I want to get as much rent as possible. As a human being, that, you know, people, the charities like Shelter, etc., have the charity shelter, etc., have done a study, and they believe that by the time the 4 years is up, 2020, that most benefit tenants will only be able to afford the bottom 10th percentile of housing stock. So if you take all the 3-bedroom properties in your area, they'd only be able to afford to rent the bottom 10%. What that's going to lead to is a lot of homelessness, because they're not going to be able to afford to rent places, and there's not going to be anywhere for them to live. So I personally feel that, you know, I feel this wasn't the right decision. I think from a social point of view, it's going to cause some problems. But that's a side note. That's not what you're here for. Okay, so number 4, corporation tax. Now, this is an interesting one. So they've said, the government have said, although there are further changes afoot, so whether it will come through, that they're going to take corporation tax down from 20% level down to 18%. So the benefit of that is if you're running your investments in a limited company, you're only then paying 18% tax on any profits instead of 20%, and that's a lot lower than 40% tax if you're a 40% taxpayer. Okay. However, if you then take the profits out of the limited company, if you draw dividends on the property, the flip of that is they've increased the tax on dividends. So actually, if you're making your money in limited company and leaving it in there, and I'll come back to that later, then that number 4, corporation tax down, is a great thing. If you're leaving it in there to grow a portfolio for the future, this is a 10, 15-year plan, brilliant news. If you're taking all the profits out all the time, though, because of the increase in tax and dividends, actually those two counter each other out. Okay. Number 6, stamp duty changes, which I'm going to cover in detail. So in April 2016, there was a change of rules to stamp duty. And number 7, April 2017, there was a change of rules to the income tax relief you can claim on your mortgage interest. It's also called Clause 24. It's also called mortgage interest tax relief or interest tax relief. They're all the same thing. The final point of note, we're going to get into 6 and 7 in detail now, but the final point of note is if you've got a holiday let property or serviced accommodation, then interestingly, they're not treated as under property tax. They're treated as a business under business taxes. Therefore, this change to income tax relief doesn't affect you if you've got a holiday let or serviced accommodation. Now, some people in the industry are using that as a marketing ploy. They're saying, this tax change, come and do holiday lets or serviced accommodation because you don't get taxed. Do not pick a strategy just because of the tax implications. Pick a strategy that resonates with you. Pick the right strategy for you. And then when you've picked the strategy, learn the tax rules. Okay. At my one-day event, I teach people the 5 core strategies that consistently make people £100,000 plus a year. I interviewed 50 people who not just had a one-off year, but consistently made £100,000 plus a year. And I interviewed those people, and having interviewed them, success leaves clues. Out of the hundreds and hundreds of strategies out there, 98% of them, all bar one, used one of just 5 strategies. So at my one-day event, I actually teach those 5 strategies so you can learn them, and most importantly, the characteristics of each one so you can decide which one resonates most with you. Okay. Only then might you pick holiday lets and serviced accommodation, one of those 5. Don't pick it because of the tax thing. Okay, but I just wanted to make you aware in case you're already in it. Okay, so let's look in more detail first of all at the stamp duty changes. So what were the changes that came in and what's the impact? Well, basically, the way that stamp duty works is in the left-hand column that you can see, the was column. So if you've got £40,000 to £125,000 purchase, no stamp duty to pay. And if you buy a residential house, by the way, the was column is the true column. If you then pay somewhere between 125 and 250, you'd pay 0% tax on the first 125,000 and then 2% on anything between 125 and 250. Then 5% on anything between 250 and 925, etc. The new rule that came in that affects investors is if you buy a second property, if your name goes on the deeds of a second property, okay, at that point, it adds 3% to the tax bill. So if your name goes on a second property that's worth £100,000, before there was 0% tax, now it adds 3%, right-hand column, you'd pay 3% stamp duty tax on 100,000, so that would be £3,000 bill. Okay, if it's in the 250 to 925, you'd pay an extra 3% on that piece. Okay, so let's show you a couple of examples. Let's take an example of a house that you buy for £275,000. So the stamp duty you'd owe the old way, 0% on the first 125 is 0, 2% on the next 125 is 2,500, and 5% on the final 25,000 is 1,250. So the total tax bill old way is 3,750. However, if this is an investment property, we now pay an extra 3% on the whole lot. So we still pay the 3,750, but 3% of 275,000 is 8,250 extra. So your stamp duty bill is now 12,000 instead of 3,750. Now, that isn't fun. When you're an investor, that's not good news. However, what happens to property prices over time? This house, on average, they double every 8 to 9 years. But let's say 15 years. So 15 years from now, what will this house be worth? An extra, that's right, £275,000. So is it going to stop me and put me off paying, because the stamp duty is now 12,000, but I'm going to get £275,000 of growth? If I'm sensible, it definitely won't. I actually think the government have pulled a good one here. Okay, I think they provided a vote winner for the masses by saying, look, we're penalising landlords. Secondly, they raise more money in tax. Thirdly, the investors will still buy, so it won't stop people from buying, because it shouldn't stop you from buying. It's not a nice tax, but we pay a lot less than the continent. On the continent, you can pay 7%, even up to 10, 12%. 12% you pay VAT on your house purchases. Okay, so in the scheme of things, this came into 2016. Most people have forgotten about it now. It's just the new norm. Do not let stamp duty be a reason not to buy. Okay, because that house is going to go up in value and make far more cash flow if you've bought the right diamond property, far more money than you're paying in the stamp duty bill. Second example, just so you've got it, £100,000 house. So previously, the tax on that was 0. If this is an investment property, the second house that you buy, the tax is now an extra 3% of the 100,000, so it's £3,000 in tax. Okay, so let's look next. Let's look next at interest rate relief changes. Clause 24, mortgage interest rate relief changes, whatever you want to call it. Okay, so in April 2017, the government brought in a new tax structure that meant that in the old days, the good old days, whatever your mortgage was costing you for the interest element anyway, whatever you were paying in interest on your mortgage, you could knock off the income before you worked out what tax bracket you were in, before you worked out your profits. Now you can only get the mortgage interest relieved at 20%, as if you're a basic rate taxpayer. So if you are a basic rate taxpayer, there's actually no changes, and I'll show you that shortly. But if you're a 40% taxpayer, there is a change. So let me show you this. So why did the interest rate relief changes come in? What were the government goals? Well, the government goals were to create larger portfolios owned by landlords, so to allow more properties to be available for first-time buyers and more properties to be available for pension releases. They're encouraging people to take the money out of the pension and buy property to build a pension for themselves. They're doing that because pensions don't work, by the way, but that's a whole other story, okay, or are not working well at all. So what's the second goal? To deal with the deficit. They have a deficit. They need to deal with it. Okay, so these are the main reasons they brought this tax change in. Now, what you need to do is work out, first of all, based on the new rules, which tax bracket you will be in. So how does this work? Well, first of all, they take your employed income, or if you're self-employed, your self-employed income. They take the income that you have. Then you add to that your property income. You can take off all the costs, so you can take off insurance, letting agent, maintenance costs, service charges, except the mortgage interest. You can't knock that off. So you take your property income, you take off all the costs except the mortgage interest, and you add that to your employed income. And that gives you your total income to decide your tax bracket. If your total income then is above, at the moment it's about 44,000 to go into the 40% tax bracket, but by 2020 they've promised that will get to 50,000. So I'm going to use that figure of 50,000. So if your total income is above 50,000, you're a 40% taxpayer. If it's between 50,000 and about 13,000, you're a 20% basic taxpayer, and if it's below that, you don't pay tax. Okay, so but the way you work out your total income now, you can't offset the mortgage interest first. So let's give you an example. Okay, and by the way, once you've done all of that, then you can claim relief on your mortgage interest at just 20%. But we're going to show you some examples. So which category are you in? you might still be a basic rate taxpayer. If you are a basic rate taxpayer, having run through those rules, there is absolutely zilch impact. Stop worrying about the tax changes. Watch my next bit on how professionals take their profits and implement it, but just stop worrying about the tax changes. They don't impact you at all. In fact, if you're under 50,000 of income as an individual, once you've done these rules, or under 100,000 as a couple, because you can share it between you, stop worrying about the changes. Okay, now, you might be somebody and it's just tipping you over. You know, you maybe were earning between you as a couple 80,000 a year, but now, and you've got 5 properties, so it's just tipping you over. That will just tip you into the higher rate tax bracket. The impact then is going to be quite modest and probably won't lead to any changes until you buy more houses. Or you could be in a situation where you're already a higher rate taxpayer, you know, like myself with 200 plus properties. I'm definitely in that tax bracket. This definitely affects me more than most, which isn't good. But then you need to use the mitigation strategies, which I'm going to share with you. Okay, so you work out which category you're in. And here's an example. If you've got employed income or self-employed income of 30,000 net, okay, 30,000 gross, sorry. You then look at your rental income. Let's say 5 properties at £600 a month for 12 months. So in this person's got 5 properties rented out. They're making 36,000 of rental income. The costs of the property, the letting agent, the maintenance, etc., let's say, are £200 a month. So they can offset those costs, but not the mortgage. So they offset 12,000. That would leave this person on £54,000 of income. Now they work out which tax bracket they're in. For this person, sadly, that's tipped them into the 40% tax bracket. Now, for clarity, the first 50,000 of what they earn isn't in the tax bracket. It doesn't tip all the income into 40%. It just tips the extra 4,000. That's why for this person, the impact is modest. They wouldn't overly worry. They need to know about it, but they wouldn't overly worry. If you're already a 40%er, then all of your property income's in that 40% bracket, then that makes a difference. Okay, so let's look at some examples. Let's show you a couple of examples. So what's the impact? Let's look at a £650 a month rental property, maybe 100k rental property, okay? And it's got costs of 200 like I just did, mortgage interest of 300. So the old way of working things out, you could knock all that off and say I made net profit of £150. You're taxed at your normal rate. So if you're a 20% taxpayer, it would be £30 of tax a month. If you're a 40% taxpayer, it'd be £60 a month. That's the way it was worked out before. Quite simple. We understood it. Okay. Now let's look at the effect of the changes and how they work. And we'll look first of all at a lower rate taxpayer. So the rent's still £650. They can knock off the costs of 200 that takes them to £450, but not the mortgage interest yet. So then they say you've made £450 of profit without the mortgage interest. 20% tax on that is £90. Okay, and it was previously 30. However, now you can knock off your mortgage interest. So 20% of the mortgage payment, and if you remember the mortgage payment was £300, so 20% of that is 60. So 90 minus 60 gives me tax to pay of 30. And if I flick back briefly to that last slide, 20% taxpayer previously paid 30. So although it's worked out a slightly different way, if you're a 20% taxpayer, the tax you pay is no different whatsoever. So stop worrying about it. Okay, less than 100,000 as a couple, 50,000 as an individual, stop worrying about it. Now, higher rate taxpayer though, let's look at that. So they again go 650 minus 200 is 450 now. You can't knock off the mortgage yet. You pay 40% tax on that. So 40% of 450 is 180. It was previously just 60. But you can only claim, your interest rate relief, but only at 20%. You used to be able to offset it at 40, so 20% relief on 300 is now £60. 180 minus 60 is 120. Previously, it was only £60 tax bill, so your tax bill has gone up from £60 a month to £120 a month. Okay, so it does affect the higher rate taxpayers. Okay, that's how it affects you. Okay, is property still profitable for higher rate taxpayers? 100% it is. It's phenomenal. You know, because of the leverage you can get in property, and I'll show some examples later on if you want to stay on and see how to build a successful portfolio. I'll show you some examples, and you know, it's phenomenally successful because of the leverage you can get, because the banks will lend you money. You can't borrow money to buy stocks and shares. You can't borrow money to build your business, or not 75% of the money you need. You can to buy property because the banks know it's safe and believe it's safe, and you know, it quadruples your results straight away. Well, more than that, it quadruples them from day one. So, okay, so it is still really works, and you can use the mitigation strategies as well. So it's not a reason not to do this, but understand the impact. Okay, now, some people say on that basis, should I be investing as an individual or a company? I've heard lots of things. What do I do? Well, it depends on your strategy, where you're trying to get to, and it depends on your tax situation. Okay, so the general rule of thumb is, if you can invest and you're not over the thresholds, then you would invest as an individual, and you'll see why a bit later on. So, but you would invest as an individual if you're in this for the long term and you're not over the thresholds. If you're going to go over the thresholds when you buy your 7th, 8th, and 9th property, you still buy the first 6 in your own name, and then you can switch maybe to limited company if appropriate later on. So again, don't worry about it, just get them and buy them until you're going to reach that threshold. If you're flipping property, that's where you buy it for a discount and sell it on, or trading property, then you want to be buying in a company. Okay. Now, once you switch to limited company, if you're, some people will switch to limited company. If you're a 40% taxpayer, you might switch to limited company for future purchases. Okay. If you switch to limited company, there is a concern that there's less mortgages available for limited company mortgages. Now, what's interesting, for many years there was, but because of supply and demand and more people wanting it now, there's more banks offering it. And because there's more banks offering it, it's got more competitive. So your limited company mortgages are maybe about 0.5% more expensive on the mortgage. 0.5%, that's it. And I think that's going to get more and more competitive. They'll never become equal, but maybe get down to 0.3% higher. So in the scheme of things, it can be tax efficient if you're in a long-term plan and a 40% taxpayer to move into limited company. But until you're at that point, definitely be buying in your own name. Okay, so as I said before, this is, it's generic advice. Go check with your accountant. Obviously, if you're building a limited company, beware it costs money to extract from it. So if this is a long-term growth plan, if you're building a portfolio for the future, then and a 40% taxpayer, then you'd buy in a company. Because you build it in the company, you don't take any drawings out, so you're not paying any tax on it. The company's getting taxed, hopefully 18% corporation tax is going to go to. You're letting the profits build up in there, and you're buying more and more and more property. Once in the future it comes to retirement time and your personal income drops, then you can start drawing the money out of the limited company, and your personal income has dropped, so therefore you're not over the thresholds maybe by then. You can also, from a limited company, pay other family members to utilize their tax allowances. You can even give them a salary, if you've got children, etc. And if you've lent money to the company to get the investment going, you lend it £100,000 to buy the first few properties and get it going, the first £100,000 of profit you can take back out without any tax at all, because it's a director's loan you've lent to the company, you can take it back out. Okay, so if you're building this for the long term and you don't need the income from it, then a limited company can be great. Okay, if you need the income from it, even if you're a 40% taxpayer, it may not be right. You need to check that out. Okay, now let's finish this piece, because I want to move on and show you how the professionals take their profits and how you need to do it too. But let's just finish this piece off. If you are in that 40% bracket and you're impacted by it, just very briefly, and I spend a lot more time on my mentorship program, but very briefly, what are some of the mitigation strategies you can use to minimize the impact? Well, here's some of them. You could pay off your high interest rate mortgage borrowings. I don't believe in paying the debt down, by the way. You'll see in a moment. If you pay the debt down, you end up paying more tax in the long run. So I'm not recommending that one. But if you're desperate to mitigate the impact, you could pay off the higher interest rate mortgage borrowings you have. Secondly, I do support this, remortgage your high interest rate mortgage borrowings to lower ones. People have got lazy in the last few years because the mortgage rates are so cheap, so cheap. They don't shop around on mortgages as much as they should. So get a great broker. We've got one if you want them to help you. Email us, info@propertyinsight.info, info@propertyinsight.info, and just say, will someone contact me about that, and we'll get someone to have a look. Okay. You could consider selling properties with high mortgage costs. Now, I don't believe in selling properties, by the way. I hate that idea. But if you've got the wrong properties, in my whole portfolio, over 200 properties, there's one property that was worth selling when I reviewed. And it was a £250,000 property that I'd bought as a residential. I lived in it a number of years ago, quite a number of years ago now. And when I moved out, I kept it because I don't believe in selling, and I rented it out. But it's rented for only £1,000 a month, and the mortgage is maybe £900 a month or something. It was just breaking even, and I was keeping it for the capital growth. Now, if you've got a property worth £250 and you're only getting £1,000 on the rental income, that one could well not be good enough. Your rental yields are not good enough on that. you should be looking to get on £100,000 purchase at least £600 of rent. So therefore at 250,000, at least £1,500 a month of rent. Otherwise, you're not getting the right yields, the right cash flow. You shouldn't be buying. Okay, so so you could consider selling those. You can reduce your personal profits. This is quite a cute one, and this is probably the one you'll use if you're at 50,000, but you want to get up to 55,000. You can use this strategy, or 100,000 as a couple. You want to get up to 110. What you do, you set up a limited company that's you. So if your name's John Smith, you set up John Smith Limited. And what John Smith Limited does, their job is to manage the investment. So you might have a letting agent already managing the property, but John Smith Limited, you pay them every month a fee for managing the investment. Someone needs to track the letting agent and check the costs are right. Somebody needs to track the mortgages, refinance at the right time. Someone needs to look after all of this. Very simple situation. And you might charge 10% of your rental income. You'd pay to John Smith Limited to manage the properties for you. What this does is it gives you an extra cost. So if you're at 55,000 and you're paying 5,000 a year to John Smith Limited, it means your personal income drops to 50. And so you don't go into that 40% threshold. The 5,000 is paid to the limited company. You'd have to pay 18% tax on it there, but that's better than paying 40% tax on it in your own name. The only challenge with that is then the £5,000 is in the limited company. So if you're going to use it to invest some more, that's fine. If you need that 5,000 to live off, doesn't work because you need to get it back out of the limited company. So, but it's quite a cute thing. And if you're a couple, there's 10,000 there you can offset. That's quite cute. It saves you £2,000 or £3,000 a year in tax, and over a number of years, it saves you a lot. Number 5, you could transfer existing properties into a company. To be honest, when I spoke to the professionals, they'd reviewed for every 100 people they'd reviewed with, maybe for 3% of the population it was worth doing. So it's very unlikely to be worth doing. Explore it with your accountant, but you could transfer your existing properties into a company. For me personally, I've got hundreds in my own name, but I'm going to just buy future ones in a limited company. You could transfer property ownership to a basic rate taxpayer, move it out of your name into somebody else's. Be aware when you transfer property at number 5 or 6, if that property's gone up in value between you buying it and now, when you transfer it, it's as though you've sold it and they've bought it. So now you've got capital gains tax to consider as well. So you need to look at that very carefully. But if you've bought something that hasn't gone up in value in the last few years, then that maybe is worth considering. You can pay more into your pension or pay more to charity. If you're just tipping over, you're at 52,000, consider giving that £2,000 to charity or giving that £2,000 to a pension that you've got, because then you can offset it against tax. Make sure you're claiming every allowance, relief, expense possible. Again, people have got lazy with that. They've got lazy collecting their receipts because the mortgage rates are so low. You could spend some money on repairs. If you're at 53, 54,000, you could say, well, I'll spend £4,000 on repairs. I was going to do them next year anyway. Now, with this one, I'm categorically clear. If they're categorically repairs you would have been doing in the next 3 or 4 months, I'm cool with you getting them done in March, so you can offset the tax. However, don't do it just to avoid paying more tax, because you'll still spend more on the repairs. So please, I've had people do that. They said, I don't want to pay the tax person, so I've spent 5,000 on repairs. But that's just save you 1,000 on your tax bill, not 5,000. Were the repairs you were going to do? No, don't do them then. The last one is consider your day job. A bit of lateral thinking, why are you in this? Maybe you're into property because in the long term, you want to be in a position where you don't work so much. Well, maybe now's the time. Maybe give up a day a week, give up 2 days a week. Yes, you'll have less income, but you'll pay less tax. For some people, that'll be right. It'll push you to make that decision. Now, just to finish this piece off, okay, deed of trust. I've continuously said if you're in a couple, you can earn up to 100,000 before it impacts you. Many couples, you've got one person earning a lot of money, 50, 60,000. The other person may not be working. They may be a housewife or a house husband. Now, if that's the situation, when you buy properties, you can still buy them together, use all the benefits of the fact one of you's got a larger income to get the best mortgages, but you can then use a deed of trust to say, I'd like to apportion the profits of this house how you want. You can say 100% to my spouse and 0% to me, or 99-1, or 90-10, or 50-50, whichever way you want to set it. So if you're earning more money than your spouse, then if you set it 99-1 to them, it means 99% of the profits go on their tax return, only 1% go on yours. A deed of trust is a simple 2-page document. Your solicitor can draw it up for you. They'll probably charge you about £150. Once you've done a couple, to be honest, you'll realize you can just do the document yourself. It's a simple document, but do the first couple through a solicitor so you know it's done properly. You need to fill in a form 17 and send it to HMRC, which is a very simple form, just to tell them that's what you've done, and then it's set. So totally legitimately transferring the profits into the lower earning name. The challenge is you need to understand is once that's set, it's set for life. So if in 10 years you sell it and it's made 100,000 gain, 99,000 that gain is your spouse's, 1,000 is yours. So whatever you, and you should never sell, by the way, but if you do, however they're set up, they stay like that forever. Or if your spouse goes back to work later, you can't then say, I want to put it back to 50-50 now, because it's set up in that way, it stays in that way. If you do want to change it back, it's like you're buying it from your spouse. They're selling again, you're back into that capital gains thing. So, but check out deeds of trust, they're really, really good. Overall, action to be taken right now. Don't panic because of the changes. Understand the changes. To be honest, we've covered what you need to know. You might need to refresh. You might say to my team, can I have a recording and watch a recording of this and just go through it again, take your spouse through it, but just understand it, consider the impact thoroughly, but get on and buy. Do not let this lead to procrastination. You can subscribe to my YouTube channel or also my blog. So YouTube channel, look for Aran Curry, or my blog at www.arancurry.co.uk, or follow me on Facebook. Find Aran Curry Property Investor on Facebook. All those places I post regular videos about the tax stuff and keep you up to date. Now, what I want to do with these last 15 minutes, probably 20 minutes, I want to show you how the professionals take their profits for property and how you can do exactly the same. Be tax efficient with your investing. Okay. Just before I do that, we run one-day events. I've alluded to them a couple of times. Live in person with me. We run them in London, Nottingham, Birmingham, Manchester, Leeds. They're the upcoming ones. We also occasionally do Southampton, Bristol, Edinburgh, other places as well. Normally those events are £297. It's a day. If you're getting value in the last 20 minutes from me, this is a whole day. 8 hours, me on stage live teaching you the 10 core elements, teaching you the 5 strategies that you should choose from to get your property investing right, showing you how, regardless of how much money you've got, regardless of how much time you've got, regardless of what money experience you've got, you can build a really successful portfolio. It's a great day. It's normally £297. In 20 minutes time, I'm going to give you a phenomenal offer on that. Okay, really phenomenal, but I'll give you that in just a moment. Okay, so let's get into the next piece, which is how do we get tax efficient. Now, if you've got your pens and papers to hand, I'd like to ask you to write down 2 statements on your pad. The first is, and then I'll explain why I've made them, but these are the core statements that will make sure you're tax efficient with your property investing. The first is, never ever sell my investment property. So never ever sell my investment property. The second, some of you will feel more uncomfortable with, but let me explain it afterwards. So the second is, as the property goes up in value, increase my debt against it. So never ever sell my investment property, and as the property goes up in value, increase my debt against it. Now, believe it or not, I'm going to explain why they are your foundational principles that you will use forever with your tax planning. They worked before the tax changes, they work exactly now with the tax changes, and they work whether you've got 1, 2, 5, 50 or 200 properties. These are your foundational principles, and it's this simple. So these allow you to be income tax efficient, capital gains tax efficient, and inheritance tax efficient. So let's go through some examples and show you how this works. Okay, so I'm going to deal with income tax first. Now, first of all, let me ask you a question. Were you brought up, and I imagine you were, most of my audience normally are, who are interested in property, were you brought up by parents who taught you that debt was bad, or loved ones that taught you that debt is bad, you should pay debts off, and saving is good? The majority of people that are interested in property were brought up by parents like that, and we need to thank those parents for giving us that thought. However, the challenge is if they taught you that debt was bad and that was it, that's a problem. Because actually there is good debt and there is bad debt. Okay? A bad debt is most debts that people have. So your residential mortgage is a bad debt. If you can stay in bed all day, when you get up, you still have to pay that mortgage. You could be on holiday for 2 weeks and not use your house. You still have to pay the mortgage. It's something you have to pay regardless. Bad debt, same as a car loan, same as an overdraft, same as a credit card. Okay? Now, a good debt, though, a good debt is a debt that somebody else pays for you and it makes you profit. So if I have an investment property and the tenant is paying the mortgage payment for me and it's making me profit, that is now a good debt. That's a debt that's making me money. Okay? So you need to understand as an investor that there's good debt and bad debt, not just the saying that debt is bad. Okay? And if you want to learn more about that, by the way, there's an awesome book called Rich Dad, Poor Dad by a guy called Robert Kiyosaki. Okay. Now let's look at this in more detail. Let's look first of all at income tax. Okay, so the income tax scenario, this is a £90,000 property, 67,500 mortgage, and I've said it's on interest only at 4.5%. I mean, these days you're getting mortgages under 3%, so it's a lot cheaper than this. But just for simplicity, this property's got the rent coming in, the cost going out. In very simple terms, I know the tax changes change this equation slightly, but basically it's making £219 a month of profit, and if 40% taxpayer pay 40% tax on it, 20% as no tax, no tax. Okay, very simple terms. Now, let's imagine we had two people. I'll take two people from the audience. I'm going to take Abbas and John. Okay, so Abbas and John have, and I don't know you guys, so this may not be the scenario, but you have identical houses. You bought next door to each other, semi-detached houses, and they're rented to the same types of tenants and making the same rent. And in your own life, you have the same jobs. Okay, everything's the same. However, Abbas's upbringing was so strong that debt was bad, that even having had my learning, he says, I get your learning, I get what you're teaching me, but I'm going to pay my mortgage off. And over the next 10 or 15 years, he works hard to pay that mortgage down. Okay, so what Abbas has done, in effect, he's over the next 10 or 15 years, he's found another £67,500 and paid the mortgage down to zero. Okay, John, in the meantime, has had that £67,500 and been able to have some parties with it and a good time and some holidays. Or, if he's more sensible, has bought 2 or 3 more properties, put more deposits down and bought more houses. So he's got more assets going up in value over time. However, let's look at Abbas's situation. What's the reward that Abbas gets for having paid that mortgage down so diligently? Well, here's the reward. They've got identical houses, identical incomes, but the government comes along and says, Abbas, you've paid that mortgage off, so there's an extra £250 hitting your bottom line. As a result of that, we're going to tax you £100 a month, which is £1,200 a year more than we're going to tax John. Congratulations. So Abbas works really hard to pay the mortgage down, uses his own money to pay it down, and the result is he gets taxed more. So first rule, you know that second rule I said, as it goes up in value, increase the debt. Well, the first bit is don't pay the debts down. On your investment properties, they're good debts. Do not pay the mortgages down. Okay, and this works, still works. I'm going to come on to it with all the recent tax changes. Okay, so let's look secondly back at Abbas's situation. So Abbas is not, John is not paying the mortgage down, but John's followed my advice from earlier. Always put the rents up 3 to 5% a year. So the 650 becomes 670, becomes 690, becomes 610, 710. So in 3 years' time, he's making an extra £60 a month. The trouble is that's going to hit the bottom line. He's going to have to pay more tax. He doesn't want to do that. Well, maintenance probably has gone up with inflation. Let's say that's gone up £10. That's now £90 per month on the maintenance. But the other thing that's gone up with inflation is the value of the house. So John goes to the bank and say, hey, this is worth more money. Can I borrow some more money against it, please? The bank say, of course you can. They say, you can borrow some more money. The only challenge is if you borrow more money, your mortgage payments will go up. And John says, well, that's fine. I've got more income coming in. So let's say the mortgage payments go up to £300 a month. He's borrowed more money. I'll come back to the more money in a moment and what he does with that. But he's got £60 extra coming in rent. The mortgage has gone up £50. The maintenance has gone up 10, so he's got an extra £60 of cost. The bottom line is his income profit stays the same every month. So his tax bill stays the same. So if he follows that second rule, as the property goes up in value, increase the debt against it, he stays income tax efficient. Income tax efficient. Now, there are some nuances with all the new rules. That's why I said this takes a day to teach, and I don't have that now. But in principle, I want you to get the principle, because the principle, even with all the nuances, the principle holds true. You need to be doing this, and I'll show you why in a moment. Okay, so we're now income tax efficient following that second rule. Let's look secondly at capital gains. Let's assume you bought a property 30 years ago for £100,000. They double on average every 8 or 9 years, but let's assume it's every 15 years. So it becomes worth 200,000, becomes worth £400,000, okay? You sell the property. The government say you've made a £300,000 gain, so therefore you're going to get taxed 40% taxpayers. You pay 28% tax on that, which is an £84,000 tax bill. So you've sold it, you pay £84,000 in tax, you pay the estate agents, the solicitors, you're probably going to net out about 300,000. Let's imagine instead you took my learnings. My learnings were never ever sell, principle one. Instead, what do? You refinance the property. You borrow 75% of what it's now worth, which if it's worth 400,000 would be 300,000. So you've still got the 300,000 out of the house without selling it. You can still go spend that money. And the rents have gone up every year, so the rents are paying for the mortgage, and it's making you £219 a month of profit. So the mortgage is getting paid. Now, what then happens if you've sold it and it keeps going up in value? You don't own it. But if you did own it and it kept going up in value, this isn't a trick question. If it's worth 400,000 now and they double every 15 years, what will it be worth in 15 years' time? That's right, £800,000. And if it doubles again after that over 15 years, whether you're here or not, your family will be, what's it worth? 800,000 doubles. That's right, 1.6 million. So the person that sold it, them and their family just missed out on a further 1.2 million pounds worth of growth that the other person gets because they followed the rule to never, ever sell their property. Now, you need to buy the right properties to start with, by the way, so they're always feeding you lots of other rules to learn on that. We're not covering that on this webinar. When we do our Done For You service, people, we buy only outstanding properties. If you want to get educated at my one-day event, I teach you how to only buy outstanding properties. But now, here's the other piece. What people don't realize is I'm telling you to keep the property to the grave. You're going to own it until you die, the day you die. Now, what people don't realize, you can comfortably get mortgage finance to the age of 90, buy-to-let mortgages to the age of 90. If you're planning like me to live beyond that age, you can get commercial finance well into your hundreds. So you're literally going to own these properties until the day that you pass away. Okay, now, if that's the scenario, if that's the situation, what people also don't understand is, say you pass away in 45 years' time, and this house is worth £800,000. So you've made a £700,000 gain for you and your family over the last 45 years. The day that you pass away, there's something called capital gains washout. The capital gains is written off. Even though you made a £700,000 gain, they say there's no tax to pay, we're writing it off. How beautiful is that? People don't realize that. So you see all these people in their 60s and their 70s busy selling their properties and paying capital gains tax to tidy things up. And I'm like, that's crazy. Die first. Now, I'm not saying die sooner, still die at the same time, but sell the houses after. Take them to the grave with you, okay? So, third tax, inheritance tax, that leads us to, okay? So let's look at inheritance tax. Now, back to our example, Abbas and John. So Abbas had paid the mortgages off. So he's getting hit for income tax for the last 30 years, paying more and more tax than John is, even though they've got the same portfolio. Let's assume when you pass away that Abbas had £1 million portfolio. Let's also assume your personal allowance, when you pass away, the first £325,000 approximately passes to your kids, and there's no tax to pay. If you're a couple, it's $650. But let's assume for simplicity that your residential property, your other assets, you've got your stocks and shares, had used up your allowances. So your property is extra, just for simplicity. So you've got £1 million portfolio. So Abbas passes away, and the government say to his kids, 40% tax to pay on the equity. So that's a £400,000 tax bill. By the way, you've got 12 months to pay me. Now, unless Abbas is a genius, he can't predict when he's going to die. So let's assume he died in a flat market. So now the kids are struggling to sell the houses quickly. They've got this tax bill. They end up selling them at discount to get rid of them quick. Abbas has worked all his life. This could be you. You've worked all your life to build this £1 million portfolio, worked really hard. You pass away. They end up selling it for $850. They have to pay the tax bill. They end up with less than £500,000 in their accounts. Now, if you follow the two core principles, though, you've got £1 million portfolio, option two, the John scenario, but he's borrowed 75% of what it's worth. He's got £750,000 on mortgages. Okay, the rents are paying for those mortgages. So if this is 8 properties, they're all making £200 a month. He's making good rental profit, and the mortgages are getting paid for. by somebody else, by the tenant. So he passes away, the government say 40% tax on the equity, but the equity is now only 250,000. So 40% of that, the kids get a tax bill. It's still £100,000, but I know which bill I'd rather get. They now maybe only need to sell one house, maybe two. I know where I'd rather be. Now, by the way, when I do my full teaching, you'll learn how to not even pay the £100,000 bill there. But for simplicity, I want you to get these two core principles. By following those principles, never ever sell your investment properties, and as the property goes up in value, increase your debt against it. We're income tax efficient, capital gains tax efficient, and inheritance tax efficient. Now, I'm sure you're now starting to see how we're being tax efficient. If I jump back to the income example though, one of the challenges is people say to me, Aaron, this all makes sense. I'm being really tax efficient, but where's my profit? I'm going to need a heck of a lot of houses at £200 a month to be making great profit. That's true. However, let me show you now exactly how the professionals take their profits. How do the professionals take their profits? So let's look at a £100,000 example property with a £75,000 mortgage on it and £25,000 of equity. Okay? Let's assume over the next 1, 2, 3, 4 years, however long it takes, the property goes up in value 20%. So it's now worth £120,000. We've got a mortgage on it. We go back to the bank. We say, can I borrow 75% of the new value? The bank say, of course you can. So you borrow £90,000 now. The rent is paying for that increased cost. You pay off the old mortgage of £75,000. So that's paid off. And the balance, the extra £15,000, what the bank do, the other mortgage paid off, the balance they put into your current account. Here's £15,000 for you to spend. Now, I want you to notice three things on this slide. The first is the right-hand column, the equity column. Even though we've borrowed more money now, the equity has gone up from 25,000 to 30,000, and next time it goes up to 36, then to 43. So it keeps increasing through the years. Okay. The second thing I want you to notice, which is really exciting, is the compound effect. Next time it goes up 20%, because it's 20% of 120, the growth is 24,000 instead of just 20,000. So the amount you can release next time, 75% of that, is 18,000 instead of 15,000. This is an inflation-proof release. The time after that is 21,600. Phenomenal. The third thing I want you to notice, really importantly, the money you release, because it's money that you've borrowed, it goes in your bank account, but it's not an income, it's money you've borrowed. So there is no tax to pay, it's tax-free. 15,000 tax-free, 18,000 tax-free, 21,000 tax-free, it's tax-free. Okay. Now, I'm sure you'd get it if I said to you, look, this is how you build a portfolio. You buy a couple of these houses. They go up 20%. Might take 1 year, 2 years, 4 years, whatever it takes. You release 15,000 on house one, 15,000 on house two. You've got £30,000. That's enough to buy number three. Now, because you've got three, what people don't realize, there's three going up in value now. They only need to go up about 13% for you to be able to release money from the three to buy number four. Now you've got four going up in value because there's four, they only need to go up about 10%. You can release and buy number five. Now you've got five, they only need to go up about 8%. You can release and buy number six. It gets faster and faster and faster and faster and faster. Start now. Get on with it. Buy them as soon as possible because you'll get to your end as quickly as possible, or you'll have a bigger end because you'll have far more. Now, let's assume you did that for 10 years. You started with two and you built a portfolio for the next 10 years. And 10 years' time, I came and saw you, said, Aaron, it's brilliant. I've got 9 properties now, because that's what it would grow to. 9 properties, and they're all worth, let's say they've gone up at just 5% a year. The national average is 7.9% a year for the last 85 years. But let's say it was just 5% a year. So they've gone up, and these properties are worth about 150,000 each. You've got 9 of them. So you've got, each of those are making you £200 a month. So it's about £25,000 a year of rental profit. Unfortunately, you have to pay tax on that bit. But on this bit, you've got a portfolio that's £1.4 million in value, $1 million of mortgages, and 350,000 of equity. Okay, now, you say to me, Aaron, that's so good, 9 houses, I'm happy with that, I don't want any more. So next year, the houses go up 5%, let's assume. So they've gone up 70,000. I come back to you and say, brilliant news. Your properties have gone up in value £70,000. You can release 52,500, just like you've been releasing through the years to buy more houses, tax-free. You can release that much. You say, Aaron, that sounds great, but I told you I don't want to buy any more houses, so I don't need to do that. I've got enough. I said, well, that's really cool. Why don't you release anyway, just like you've done for the last 10 years in the same way, tax-free, but instead of buying more houses, Spend it on a car. Go on holiday. Quit your job and live off it. It's tax-free. It's like having £70,000 salary. By the way, next year, 5%, you can release 55,000. The year after that, 58,000. How cool is that? By the way, if you're not smiling, it's probably because you're in your head listening. Smile. This is amazing. This is amazing stuff. Now, a couple of bits. You might say to me, look, Aaron, the market's not going to go up at 5% every year, just standard. That's true. So some years you get double-digit growth, 10% growth. You can release 105,000. What you have to do is stick to your budget. So when you can release 105, you still just spend 52.5. The other 52.5 goes in a rainy day bank account for the poor years. That might happen for 4 or 5 years. You've built up a really good contingency, and then you might have 4 or 5 years where it doesn't go up at all, or it's a bit negative, and you live off the contingency pot. If on average it goes up at 5%, then this is what on average you can release. Okay? So you put your averages in. Remember, 5% is actually, when you compound it over 10 years, it's half of the national average compounded. 7.9% compounded is double 5% compounded over 10 years. Okay, so I feel really safe and secure modeling that. Now, the other thing is, you might say, Aaron, I only need 30,000 tax-free on this right-hand side, and I only believe it'll go up 4%. I say, fine. Well, 30,000 means you need 40,000 of growth. At 4%, that means you need £1 million portfolio. We now know what size portfolio you need. Somebody else says, do you know what, Aaron, I need 60,000 tax-free, but I also only believe 4%. Great, 60,000 means 80,000 growth at 4%. You need a £2 million portfolio. Once you understand this equation, you can work out what size portfolio you need to build to be able to release tax-free the amount of money you need. Beautiful. Okay. The summary here is never ever sell your investment properties. As the property goes up in value, increase your debt against it. Use this strategy with 1, 2, or multiple properties, and gear at 75%. By the way, gearing is how much you borrow. If the house is worth 100,000, how much you're going to borrow against it. I'm saying borrow 75% of it, so you borrow 75,000 in that example. As it goes up, you borrow more. Okay. There are mortgages out there at 80%, 85%. For me personally, it's in my interest to get people to gear higher because they buy more houses with me on my done for you, but it's too risky. I don't tell them to. You want to leave headroom of 25%. Safe, secure portfolio plan. Make sure you always leave headroom to protect you. But don't gear lower than that, though. You want to gear at that level because that's where you get your leverage and that's where you get your real growth. You'll see that in a moment when I show you building a portfolio. So that has been briefly and quickly the time-tested tax toolkit, which is all part of the safe, secure portfolio plan. Okay, now I said, by the way, I know you've been typing questions in, which is awesome. Keep typing those in. I said I was going to make a phenomenal offer for you. Just before I do that, I just want to check if it's worth me staying on. I said at the start, I said, we'll go through and do the tax stuff. I said, if people want me to, I'll stay on and show you how, with our done-for-you service, we build a really awesome portfolio for people. So we can show you how, with 105,000 investment over maybe a 10-year period, you can build a portfolio of 8 to 10 houses and be taking a tax-free release of 40,000 per annum, maybe up to 60,000 with the rental profit as well. So I've just put a quick poll up. If you can't click on the poll for any reason, just type in the chat box. It's private there. Would you be interested in me staying on for another 20 minutes and showing you how to build a portfolio with about 100K investment? You can invest less than that, but how you build a portfolio that creates that kind of income. So you might be a yes, please, I'd like to know more. You might be a maybe, I'd like to know more. Like to see some more. Or you might be a no, thank you. I'm just here for the education on tax and I don't want to hear anything else about building a portfolio, and that's fine as well. So what I'm going to ask is each and every one of you, I'm going to grab a quick drink, but can I ask that you click as quickly as possible on the relevant tab that's relevant for you. So, every single one of you can click one of those. If you can't click, then just type it in the chat box so I know. I don't want to stay on and do it if none of you want it, but just so I know. I mean, from early guidance, I can see there's about 78% of you are either in that yes or maybe bracket. Most of you in the yes bracket. So, but yeah, click as quickly as you can. I'll grab a very quick drink. I'll be back with you in 30 seconds. Click right now or type it in that chat box. Okay, so yeah, so we've got loads and loads and loads of you, hundreds of you wanting me to stay on and cover that. So we'll do that in just a moment. Just before we do that, and as I said, if you can't click on the poll, type it in the chat box just so I can see, and I can see where you're at with this, and it's fine either way. The final piece, for those of you who are just here for the education, and also for you, those of you that want to know how to grow a portfolio, I said I'd give you one final phenomenal offer. I like to make people's transactions with me a no-brainer. Okay, you'll see that when I cover our done for you service shortly and how to build a portfolio. You'll see we make it a no-brainer. I want to do the same with education. I want to help you get to your next level of education. I know if you spend time around me, by the way, I'm not stupid. I know if you spend time around me and I give you awesome content, eventually at some point you'll go, what else do you do? And then you'll buy one of my products. You'll work with me on something, okay? But you've seen I'm here to give great, awesome content. My one-day event is normally £297. As a thank you for you spending this time with me today, I'm going to give you a gift. You can come and spend the day with me, a full day, 8 hours live, me on stage, teaching you at any of those venues. You can come and spend that day with me for free. I'm going to give you a full day with me, totally and utterly for free. Remember, at that day, we're going to cover how, regardless of your time, your money, or your experience, you can grow a really, really successful portfolio that makes you £40,000 to £100,000 plus a year. We're going to cover the 5 main strategies in property and how to choose the right one for you. We're going to cover the 10 key areas that you need to master in your property investing and how to get to an 8, 9, or 10 at each of them. We're going to cover how to make sure you only ever buy outstanding investment properties. Only ever buy outstanding ones, what I call diamonds. You don't want rubies or emeralds or lumps of coal. You want diamond properties. You're only going to buy 8 to 10 of them. You may as well make sure every one you buy is outstanding. All of that from me in person for free. On top of that, if you want to click through and do that, here's the website you need to go to right now to get your place. So while I'm talking, just type it in, bottom left there, www.arancurry.co.uk/PSS1. PSS stands for Property Success Summit. That's the name of the one-day event. So www.arancurry.co.uk/PSS1. What I'm going to give you, as well as that ticket, is if you've found great value in this webinar, I've got my Property Investing Made Easy Masterclass. Okay, my online masterclass. Now, there's an image there of it. You know, it's a DVD box set. I'm not going to give you the DVD box set. That'll cost me a fortune to send that to you. But I'm going to give you online access to all of that for free. For free. So, you know, you can get that for free. You can get the course ticket for free as well. You're going to pay a price of nil, nothing. Okay? So if you would like to claim that, just go to www.arancurry.co.uk/PSS1. Okay? This is a webinar only offer. Go grab it. Okay? By the way, when you go to that domain name, this is what you're going to see. You're going to see the Property Success Summit. There's a whole page that tells you a load of information about it. It's totally free, and it'll have the upcoming events in that bottom bar there. You can see some example events, but it'll have the upcoming events and dates so you can choose appropriately for you. Okay? Then once you've clicked to say you'd like to register, it will ask you just for your name, your email address, and your phone number. You click register now. Okay, and once you register, you'll get a thank you page, so you know that you've got registered, and then we'll email you a link so you can get live onto your Property Investing Made Easy Masterclass. You'll get a link and you can get that straight away. So go ahead right now and get that. It's totally free, so you may as well. www.arancurry.co.uk/PSS1. Okay, now while some of you are going and doing that, okay, I feel like pausing, but I know you'll do that while I'm talking, so I'll let you get on and do that, okay? By the way, yeah, just go ahead and do that. That's available for you until midnight tonight. Midnight tonight, you can go to that domain name and get yourself registered, okay? So, and if you, final piece, if you're not sure where you want to come to or when you can come or which venue, there's also a TBC button. So you'll see the next 3 events we've got, but if none of those suit you or the dates don't suit you, just click the TBC to be confirmed, put your details in there, and then the team will reach out to you and they can tell you the events for the whole of the next year, and you can pick the relevant ones that's best for your situation. Okay. So let's move on. While you're doing that, let's move on. So we said that we were going to look at the how to build a really successful portfolio. Okay, so I'm just going to spend maybe 20 minutes just doing this with you, or maybe 15, 20 minutes. So how do you build a really successful portfolio? Well, the first thing is you have to be buying diamond properties. You have to be buying the right properties, the right investments. We call it our 6 C's. I don't have time to cover that in detail, but we're ruthless, absolutely ruthless. Okay, my team look at over £100 million worth of property a month and sift through that to find outstanding properties for our clients. As I said earlier on, we bought over 1,000 properties for our clients. We know what works. Those 6 C's are crucial. This product that we have called Cash Flow Builder is designed to do exactly that, build you cash flow as well as asset growth. When you buy an investment, you want to be getting both. Great cash flow today and great asset growth in the long term. Both are critical. It's ideal for people. Any successful, one of the things I teach is any successful property purchase needs 3 things at the table. You can provide all 3. You can provide the money. It needs money. You can't buy a house without money. It needs time. Somebody has to put the effort in to source an amazing deal, to negotiate on it. Somebody has to put the effort in to learn those skills. Somebody has to put the effort in to pick the right mortgage, to pick the solicitor. Somebody has to put the effort in to refurbish it. Someone has to put the effort in to manage it long term. And it needs experience. You know, when I started investing, my first 10 properties were a disaster because I was putting the time in. Now a good friend of mine, Mark, was putting the money in, and neither of us had any experience. So we were losing hundreds of pounds, thousands of pounds, a couple of times, tens of thousands of pounds, making big mistakes because we didn't have the experience at the table. It was only when I committed to mastery and realized how much someone with experience could teach me what they'd learned in decades in just a few days, and suddenly my investing rocketed. Okay, so you need to have all 3 at the table. You can bring all 3 to the table. However, what we do with Cash Flow Builder, if you have got a lump of money and you really don't have as much time as you'd like, you don't want to create a second job for yourself, I'm assuming, or you don't have the experience, then this product could be perfect for you. Okay, we've got clients who join us who are just starting out and they say, I need someone with experience. This is perfect for me. You know, great investment value. I would need someone with experience. We have clients who've got 3 or 4 properties and they're saying, do you know what, this takes a load of time. I wanted to be an investor, but I've created a second job. I don't have time for this, but I want more. Can you do this? And you've also got more experience. You've bought a lot more than 3 or 4 or 5. Okay, and we have people that have 10, 11 plus who go, do you know what? I've got some experience here. I could probably keep doing this myself, not as well as you, but I could do it myself. But I really don't have the time. This is hassle. Here, you go do this for me. Okay, so when we're investing for you, we're buying outstanding properties. The best properties at the moment in the UK are in the price bracket of 70 to 130k of value. That's the sweet spot when you're investing in the UK. Okay, and if you don't believe that, just go tonight on Rightmove or something like that, type in and look, find a house anywhere in the UK you can buy for £100,000. And, you know, check the rent on it. It's probably about £600 a month, depending on the area, thereabouts. Then in the same area, find a house you can buy for £200,000 and check what it will rent for. And it won't rent for £1,200. It won't be double. It'll be £1,100, maybe £995 in that example. So you want to be getting the best yields. The sweet spot is 70,000 up to 130, probably up to 125 normally because of the stamp duty kicking in at 125. So that's where you want to be buying your properties. If that's not in your area, if you're listening from me in London, family lets don't work in London. You shouldn't be buying family lets in London because they're upside down on cash flow. They wouldn't pass what we call the 6 C's. They're not diamond properties. Your property should make you money regardless of what's happening in the marketplace. All weathered in all seasons. When the market's flat, when it's rising, it should be making you money. So we buy outstanding diamond properties. It's safe and secure. We follow all the stuff I teach, all the rules I teach. You've heard a snippet of it today. 20 days worth of content, all taught into my teams. You've got no tie-ins of any type. Okay, you're not tied to us in any way. It's bespoke and personal to you. I'm going to show you an example in a moment how we build a portfolio, but we actually bespoke it to you. We build the portfolio in a bespoke way for your goals. What resources do you have today? What are your long-term goals? And then let's build a plan for you. Okay, because everybody's plan's different. Everyone's outcomes are different. Okay. As an aside note, most people who do our done-for-you service are like, just get it done for me. I don't need to learn about this. But other people say, while you're doing it for me, will you also teach me? For that reason, all of my educational stuff, my 3-day event, my 60 hours online trading that lasts a year, my personal forum where you can come on and ask me any question you want for a whole year, and I personally go on there and answer you, so you've got me as your personal mentor. When you invest with us and we buy properties for you on this service, then once you've got, and forgive me, we've got the wrong number on there. Once you've got a total of 4 properties in your investment portfolio, so a total of 4 properties in your investment portfolio, once that's actually happened, then what happens is you get access to all of my education for free, every last bit of it for free. Okay, so you know, some of you will go, it's done for you service, you're doing it for me, I don't need any education. But others will go, wow, you're going to teach me while I go along, so you can start buying some for me now. That'll be really get me going and get things successful. But if I learn while I'm going along, eventually I might take over and buy them myself. Often you won't do, because you'll realize it's hard work and how good we are, even though you've had the learning. But you can do that. You can learn and then do it yourself. Some people invest some money with us, get the learning, and invest some other money themselves. Depends what monies you've got. Depends what your goal is. It depends what you're trying to achieve and what you'd like to achieve. So you've got the capability, you've got the ability to be able to invest in the way that you'd like. Okay, it's all hands-free. This is a hands-free investment. So you're going to invest anywhere from 35,000 up to 700, you know, 750,000. You'll see it's multiples of 35. A typical investor with us, a typical investor normally invests at about the you know, around the forgive me for losing my flow there. A typical investor normally invests around 105 to 140,000 pounds when they invest with us. That's the type of level that they're investing at. However, you may decide that you want to invest just 35,000. You may decide you've got far more, you want to go a lot quicker. This is again where we said we need to bespoke this for you. We need to make this a bespoke investment, so you know exactly what the returns are you're going to get from the investment, and you know exactly how this particular investment is going to grow for you. So we bespoke it specifically for you. Now, what we're going to do is look at an example property. Let's look at an example investment and what you'd be able to achieve if you were to invest with us. So, you know, if a typical property is between 70 and 130, let's take a scenario and let's assume that you invest and you buy, let's say, a £90,000 property for now. Let's look at that threshold. You buy a £90,000 property. So when you buy this £90,000 property, then you're going to need to put down a deposit. So let me catch your screen up so you can see this. So you've got a £90,000 property. I'm going to give you an example, by the way, of a £105,000 investment, because that's a typical investment with us. So your £90,000 property, you put down a deposit of £22,500, and you get a mortgage of £67,500. And by the way, this house I'm showing you here, there might be part of you going, that doesn't look particularly nice. We're used to buying with our hearts. When we buy a residential property, we make heart decisions. We buy as a home buyer. So many investors, when I start working with them, they walk into a property, they can't help it, their brain goes off, would I like to live here? That's not important. It is important that lots of people want to live here. One of the checks that we run is to make sure at least 10 people reply to an advert in the first week. If they do, you know it'll rent easily. If they don't, we walk away, however good the deal. Okay, that's one of the things that makes us reject a lot of property. But if you've got 20 people who want to live here, it's irrelevant whether you do. Okay, so this example, once you're an investor, you think with your brain, not your heart. And one of the challenges we have is our connection with investing or with homes is a heart connection. So I'm going to move you into your head. So this is an end terrace. It's actually looks like it's like a semi-detached. It's an end terrace in Leeds, 3-bedroom property. So you buy this property, you've put a £22,500 deposit down. Now, what else happens here? When you put that deposit down and buy this property, you also have other costs and fees. So what I've done is I've listed the typical costs and fees for you, so you can see what those costs and fees are. Okay, and they're scattered across the page there just to confuse you. But basically, the typical costs and fees when you buy an investment property that you come across are you've got a solicitor, and included with the searches, the solicitor is going to cost you about £1,000. Okay, you've got a mortgage valuation to pay for. Typical mortgage valuation is about £355. You've got a gas check and an energy performance certificate, which is about £130. I've built into the factoring here, I've built in paying for the refurbishment. Now, a typical refurbishment is about £3,000. Okay, so now because we're refurbishing 15 to 20 properties a month, then when we're refurbishing, we really drive the cost down, and that economy of scale gets passed on to our investors. They don't pay extra. So you're going to get maybe a kitchen, a bathroom, a redecorate for that investment amount. Okay, now if the refurbishment is going to cost a bit more, we need to negotiate even better and get more money off the price. Okay, we've covered the tenant fine to get your first tenant. We've covered the mortgage broker's fees. We've covered the stamp duty. So you've spent about £8,000 to not just buy this property, but refurbish it, get it ready to let, get it tenanted, and get it bought. Okay, so every cost has been accounted for there, and I thought I'd list them for you so you've got those costs there. Okay, so if we go back to the previous page, then when we go back to that previous page, you've spent $22,500 as a deposit and another $8,000 approximately on those costs. So you've spent about £30,000. Now, the Insight Group doesn't do all of this for free. We're going to build you an outstanding portfolio. So we're going to find the house, negotiate on it, diamond houses only, negotiate on it, sort the solicitor out, get you the best mortgage sorted, make sure it's the best mortgage, get the property bought, then refurbish it for you, organise the refurbishment, then sort out a world-class letting agent to manage it for you. Okay, and then on top of that, for at least 12 years, probably longer, however long you want us to do it, we're going to keep tracking that house's performance. Because if we buy you 3 to start with, in a couple of years we can say release money from number 1 and 3, you can buy number 4. A year after that, release number from 4 and 2, you can buy number 5. From 5 and 1, you can buy number 6. We're going to track that. If you track that intelligently and articulately, every 6 months we'll review. You'll know where you are, you'll know where you're going. If we track that sensibly, articulately, what we can do is knock at least a couple of years off your investment journey. If it's going to be a 12-year plan, it becomes a 10-year plan. We do all of that in with what we do. Okay, so what do we charge for doing that? You can go online tonight. You can go do this yourself. It'll cost you nothing, but it'll cost you a lot more when you make those mistakes and don't buy outstanding properties, and it'll cost you a load of time. That's option 1. Option 2, you can Google property sourcer tonight online. Loads of property sources, professional people who make a living sourcing properties will come up. What they do is find a motivated seller, put you in touch with them. They charge about £3,000 for that. But you then have to sort everything else out. The mortgage, the refurb, the finding the letting agent, the management, they get the property bought, and then managing it for the next 12 years, making sure it's refinanced, making sure it's on the best deal. You have to do all that yourself. And it's cost you £3,000. Okay? So what do we charge? There are 2 simple investments with us. If you're going to invest with us to do this, very simple. We charge £3,500 plus VAT. That is it. That covers doing all of this for you and mentoring you for the next 12 years to make sure you're always refinancing when you should and buying more properties and building an outstanding property portfolio, plus all the bits today to find a great property in the next 4 to 8 weeks, then get it bought for you, then sort the solicitors, then sort the mortgage, then get it refurbished for you, manage all that so you don't even have to do any of this, and then get a world-class letting agent to manage it. And our world-class letting agent, by the way, is Rental Insight. Now, I haven't gone crazy. Out of that £3,500, we make about £1,000 of profit. That's it, because I've got 4 full-time professionals finding these great deals. But we do volume. We'll do 30 properties a month, okay? More importantly for me, we'll then let the properties for you and manage them. You're not tied to us. You don't have to use us. Remember, no tie-ins. But if you do use my letting agency, Rental Insight, they've got very average fees, $400 plus VAT for a tenant find, and then separately, 10% plus VAT to manage the property. So if we collect the rent, we get 10% of it. If we don't collect it, we don't get paid, so we're going to collect it. Okay, our properties run at 98% occupied, 95% rent collected, because we're only buying outstanding properties that will rent well. Okay, it's because we want to make it win for us as well as you. So the benefit I get is if you're never ever going to sell it and I give an outstanding service at my letting agency, I get a client for life for the letting agency. Okay, so very, very simply, that is it. That's your investment. So do you want to put all the effort in yourself and all the time in yourself to source your properties and to get them bought and to manage them and know when to refinance them? And do you have that experience? If you feel you do, then come to my one-day event. I'll educate you. If not, though, this service will do this for you. That's a real minimal investment at £3,500 plus VAT to guarantee you'll have an outstanding property, to guarantee successes you'll get. I haven't covered it in detail tonight, but to guarantee those things. Okay. So, by the way, if you're interested in this, I'll send you out a lot more information. You can check it out. For clarity, no profit share with me. I used to have a product where people, in fact I still do, where people give me a share of the profits, a share of the upside for some service I bring to the table personally. But that isn't this product, for total clarity, if you've seen anything else. So that is it. That's all that you pay, no hidden costs. So let's go back to the example. We buy this property. You've spent, in this example, $30,500 to buy it and pay all the costs and fees and get it rented, and then just £4,000, £3,500 plus VAT with us. So you've just spent under $35,000 to buy your first property. So with $105,000 invested, you'd be able to buy 3 of these. 1, 2, 3. You've got 3 properties all bought, all refurbished. They're probably worth about £93,000 each because you've refurbished them, because they've all, you know, decorating the walls doesn't have value, but kitchens and bathrooms does. And you've got 3 properties all up and running. Now let's fast forward this. We take these 3 properties. Now we're waiting for the market to go up. The market goes up over the next. We assume 0% growth year 1, and then just 5% per year after that. Okay. So if let's assume that in that scenario, these 3 properties in 3 years' time are worth about £10,000 more. We go back to the bank. We say, can I borrow 75% of the new figure? They say, of course you can. You could borrow just under $77,000. The rents have gone up. They're paying for the new mortgage. Your old mortgage was $67,500, so you're able to release $9,400 on property 1, same on property 2, same on property 3. You've released £28,000. Okay. On top of that, they've been making rental profit. Now these properties, we guarantee an 8% yield. That means if it's a £100,000 property, we're guaranteeing on a £100,000 property that it's going to rent for at least £8,000 a year, which when you break it down is at least £670 a month. They're good yields that these properties are bringing in. Okay. So, but as part of making that guarantee to you, you need to know that we're then going to deliver on that guarantee. So what we do is we say that that will equate to at least £200 a month of net profit, a minimum of £200 a month of net profit. However, you know, because I want you to plan for worst case, I've modeled this on only 5% growth. The other thing that we've modeled this on is we've modeled it on assuming they only make you £100 a month less than they're actually going to make you. In fact, probably more than that. But if we assume that they're going to make you £100 a month less, then we assume they're only going to make you £125 a month of profit, to be really cautious. So if that was the scenario, and we've got that scenario, then the rental profit that we've got kicking in is about £4,500 a year. It goes up a bit with inflation. So you've made in 3 years £28,000 of growth that you've released and about £14,000 of rental profit. That's £42,000 on the right-hand column. That's enough now to buy property number 4. You've now got 4 properties. This is assuming you leave your rental profits in. Some of you will want to take those out and spend them. It'll just take you a bit longer to get property 4. Some of you will leave all your profits in and you're growing this for the future. The bottom line is by the end of year 3, you've now got 4 properties. And even though you've had to pay these $8,000 of costs that you have to pay as a one-off when you first buy a house, one-off cost, you keep the house for 40 years, but you only pay all those costs once. Even though you've paid that across 4 houses, you've still got 41% growth on your money. Even that. Now let's now fast forward this and get exciting. 4 properties go up in value. Those 4 properties go up in value over the next couple of years. You can release money and buy the 5th. Okay? And then the 5 properties go up in value, etc. So by year 7, let's look at this table, make it simple. In year 7, you can release £35,000, but you need £44,000 to buy the next one. So you don't buy any properties that year, you stick at 5. Now in reality, you could add to this, you can always, it's bespoke, you can add to it. You can take it out of it. That year you might add some money and speed it up. Year 8, you can release £68,000, you need 46, so you can buy one. You get 6 properties. Year 9, you buy another. You can see now by year 8, you're buying 1 property a year. By year 13, you start buying 2 properties a year. How it speeds up and speeds up. Okay, really phenomenal. Now here's the exciting bit. Remember, this is a $105,000 investment example. You can invest less or more. With $105,000 by year 7, if you stopped at that point and said, Aaron, I want to stop now, you've now got 5 properties. Each of those, let's say they're making you £2,000 a year of rental profit. You have to pay tax on that, but it's profit. So 5 times 2,000, that's 10,000 of rental profit. But the final column here is the exciting one. Based on what you've learned tax efficiently, you'd be able to release $23,400 a year, inflation-proof for the rest of your life, tax-free. Plus the 10,000, you're on $33,000 a year. Now, Let's say that's not enough for you. You might go 10-year plan. 10-year, 105,000 invested, being cautious. You'd have 8 properties. You're releasing 43,000 a year tax-free, plus 8 times 2,000 is 16,000 rental profit. You're on 60,000. Some of you go, that's not enough. I'll have a 12-year plan. 60,000 releases tax-free. It's the equivalent of about 90,000 of income, 85, 90, plus 10 properties at 2,000 a year, 20,000 of rental profit. You're over £100,000 equivalent from 105,000 invested to start with. Okay. If you don't do it with me, please do it. But we will do this for you. There is all the costs are included in your 35,000 investment, or 105 or 250, whatever you put in, everything's included. Now, if this is of interest, I want to finish off the webinar. If this is of interest, remember you get all the education in with this. Remember you've got peace of mind because we're buying diamond properties. You need to learn what they are. You know, remember this is bespoke and personal to you. We look at 100 properties just to recommend one to you thoroughly. Professionals, people who do this for a day job, sifting through, and you've got no tie-ins whatsoever. You might commit to building 10 properties, but you can stop whenever you want, not tied to us at all. You don't have to use my letting agency. If we're outstanding, you will. Every investor has. But if you don't want to, you can manage them yourself. Okay. Now, if this is of interest to you, okay, if this is of interest, then what we can do is, what I'm going to do is slip up a poll for you, okay? If this is of interest, then, and you would like to reserve a slot, then just click on the poll and let me know. If you can't click for any reason, type it in the chat box. So what I'm going to say about reserving a slot, by the way, we work with 10 clients every month. We know we can buy 30 properties a month on cash flow builder service. An average client invests 105,000, often a lot more. So they need 3 when they invest. So 10 clients times 3 is 30 properties. So we cap ourselves at 10 clients. We find our clients through webinars like this, or through the events that we do. When we're at the events, people love what I teach, and then some of them come up and say, I love that. I can see that you're a genuine guy. I'd like to use you to build a portfolio for me. So we know we'll easily reach 10 a month. We always reach that capacity, no problem whatsoever. Okay, so we're not, there's no pressure here from us, but if it's potentially of interest, what we don't want you to do is be in a situation where you're fighting with others for a slot. So what we say is, you've spent an hour and a half with us now today. Because you've spent that time, I'd like to give you the opportunity to reserve a slot. When you reserve a slot, what we'll do, my team will work with you over the next 21 days to get you everything that you need. So they'll email out to you in the next 48 hours, probably the next 24, they'll send out to you a full copy of a webinar, just an hour and a quarter, me going through the cash flow builder model. We've done it in 20 minutes now, the detail. A, so you can watch it in detail, see how to buy golden properties, how we build it up, but B, you can share it with spouse, loved ones, other people who are a part of this decision. Secondly, we'll send you a spreadsheet. You can then drop your own numbers into that spreadsheet. You can say, well, how's this going to work for me? If I put an extra 10,000 a year in, what would that look like? If I invest 350,000, how fast could I retire? How fast could I build a 40,000 income with 350,000? Might be in 2 or 3 years. You know, you can look at all the different scenarios. Okay, and then on top of that, my team will make sure we answer every single question. You need to do your due diligence and check us out and decide if we're the right company for you. And we know, out of everybody that reserves a slot, a third go ahead in the next month with us. They're ready to rock and roll. They might need to release some equity from their own house, but we'll help you do that as well. That's part of the service. We'll help you to review and see what you can release if you've not done that. We can do that for free with my mortgage teams. A third of you will go ahead straight away. A third of you will go ahead over the months to come. And a third of you won't. And that's fine. We'll just get you all the information and you can decide. But you need to reserve a slot, because then what we'll do in the next 21 days, my team will just focus on you. They won't focus on other people, and they get all your questions answered, so you can work out if this is for you or not for you, and either way is fine. Okay. By the way, you might want to, in your due diligence as well, ask to speak to previous clients, people who are getting an outstanding service for us already. And I won't just give you my 2 best friends' phone numbers to ring up. I'll give you, here's a list of 15 people. Take any couple you want and we'll introduce you. Then here's another list of 15 if you need some more. Pick another couple. We've got stacks and stacks of really happy clients. So lots of you have clicked already. It's either yes, please reserve me a slot. Maybe interested, please send me some more information. Okay, we've got about 40% of the audience have clicked yes, please, which is ace. We've got about 20% in that maybe. We've got some people clicking, can I come and visit your offices? You absolutely can. You know, you meet the team then. It's not just me on a webinar. There's over 40 members of the team that deliver this service. Come and visit us. Our head office is in Scarborough, just to make you aware. 3 hours approximately on the train from London if you're coming from the south. But come and join us, okay? You might want to attend one of our discovery days. A discovery day is specifically for this product, so it's not a training thing. The training thing was my Property Success Summit. We did that earlier. A discovery day is me in person, again, whites in my eyes, you get to meet us, and we spend 4 or 5 hours. You're in a group of 10 to 20 people, and we go through this in detail. And then you can, again, helps you work out if this is for you. So you might prefer to do that and attend a discovery day. If you're down south, we run them in London and Scarborough. So if you're down south, you might prefer to go to London and do that. Or you might be saying, no, thank you. I was just here for the education. I was just having a look and seeing what you were doing. So if I can just ask each and every one of you to click as quickly as you possibly can. If you're not able to click for any reason because of your software, type it in the chat box. But can every single one of you, you'll be one of those things. If you don't click anything, my team are going to ring you to get feedback. So they're going to ring you up anyway. So you may as well click one, and then we know which you are, and we just send you the right information. You know, if you're a yes, please, or a maybe, we'll send you the information. If you're a discovery day, we'll send you the information on the discovery days, the dates, and get you booked on one. If you want to visit the office, we'll contact you, arrange to do that. If you're a no, thank you, that's totally cool as well. So click as quickly as you can, type it in. I'm going to grab a very quick drink, and we'll just spend a couple of minutes to finish off. So back with you very shortly. Okay, so thank you for clicking so quickly. There's about 70% of you either in that yes, that maybe, or can I visit, or discovery day. So I'm delighted about that, and I really, really look forward to working with you. We'll get all the information out to you, and then you can work out if we're the right fit for you. That's absolutely great. Okay, so as I said before, if you can't put your information in there, then use the same headings. But yes, please, can I reserve a slot? Maybe, please send me information. Can I come and visit you? Can I book a discovery day? Or no, thank you. And just type that in the chat box so my team know where you're at. Okay, so we're going to finish off just by saying, look, when you move forward, you want to invest with knowledge, you want to invest with confidence, because you can create financial freedom. You know, I've helped people, hundreds of people now, move from wherever you are right now across to financial freedom through property, either on my Done For You service or my education. You know, some of you will have taken that offer. Some of you will have said, you know what, I want to reserve a slot. He works with 10 clients a month. Bought over 1,000 properties. I'd like to reserve a slot. I'd like to work on that. Some of you will want to attend the education. You'll have booked to come and attend the education. By the way, if you weren't able for any reason to get to www.arancurry.co.uk/PSS1, that was to book your one-day event. If for any reason you couldn't get on the domain, for any reason, I'm sure you could, but I'll put a poll up for that as well. So you can click on this to say, yes, I'd like to come to the one-day event. This is different to the discovery day. This is education. Please, can you call me and sort the details? You might say, maybe, can I have more information? Or no, thank you. So again, click on that. Or if you're not able to click, type it in the chat box, but make sure it's clear that this is about the one-day event. Can I come to the one-day event? Maybe I'd like the one-day event information. Or no, thank you. Put that in the chat box. Or just click the relevant one. Okay, so we're going to finish off now. So bottom line, invest with knowledge, invest with confidence, create financial freedom. I really, really hope you've enjoyed the webinar. I wish you all the best for your investing, whether you do that with us or yourself. And yeah, best wishes. You will get invited to some further webinars. I run webinars every couple of weeks. Come and join us on those. Get my free education, and I look forward to working with you. Best wishes. Thank you. Bye.